Right now, something massive has already happened in the global financial system, and almost nobody is talking about it. No emergency headlines, no breaking news alerts, no market panic on your screen, but quietly, behind the scenes, nearly $4 trillion has left the system. Not vanished overnight, not in a dramatic crash, but slowly, silently, and deliberately. In history, shows us something uncomfortable. Whenever money leaves this quietly, something breaks later. Add macro signal. This is exactly the kind of moment we watch closely, because these are the moments that don't feel dangerous till it's too late. Think about this for a second. Markets look calm. Indexes aren't crashing. Volatility feels low. Most people assume that means stability, but calm markets have a habit of hiding stress. And the most dangerous financial events don't start with chaos. They start with silence. They start when liquidity slips away quietly, when credit tightens slowly, and when confidence fades just enough that nobody notices at first. That's exactly the environment we're in right now. Before we go deeper, if you read someone who wants to understand what's really happening beneath the surface of markets, not the headlines, not the hype, make sure you like this video and subscribe to Macro Signal. It helps the channel grow, and more importantly, it tells the algorithm that this kind of deeper analysis matters. Now, let's continue, because what's happening right now connects directly to how financial crises actually began. Liquidity is the lifeblood of the financial system. It's what allows banks to lend businesses to operate and markets to function smoothly. When liquidity is abundant, even bad decisions can survive for a while. But when liquidity starts to drain, weaknesses are exposed fast. Over the past months, trillions of dollars have quietly moved out of the system through tightening credit conditions, shrinking balance sheets, and reduced lending. None of this feels dramatic on the surface, but it creates pressure in places most people never look. What makes this moment especially dangerous is timing. Inflation pressures haven't fully disappeared. Central banks are still cautious. And debt levels across governments, corporations, and households are historically high. That combination means the system has very little room for error. When liquidity leaves during times like this, it doesn't just slow growth. It amplifies every small shock. A missed payment here, a failed refinancing there, and suddenly stress spreads in ways that seem sudden, but were actually building quietly for months. If you look back at previous crises, the pattern is almost always the same. First comes the quiet tightening. Then confidence starts to fade. After that, markets begin to move in strange, uneven ways. Some assets rally while others freeze. Credit spreads widen. Liquidity pools dry up. And only at the very end do headlines finally catch up and call it a crisis. By then, the damage is already done. This is why Macro Signal focuses on early signals rather than late reactions. What's happening now fits that early stage pattern uncomfortably well. Money isn't flowing the way it used to. Lending standards are tightening. Institutions are becoming more selective. And while this looks like discipline on the surface, it also means fewer buffers when stress hits. The system becomes brittle. It can look fine, right up until the moment it snaps. Most retail investors never see this phase clearly because it doesn't feel urgent. There's no crash to react to, no obvious fear signal. But this is exactly when positioning quietly changes behind closed doors. Institutions prepare long before headlines turn negative. They don't wait for confirmation. They watch liquidity. They watch credit, and they move early. And here's the uncomfortable truth. By the time everyone is talking about it, it's usually too late to act calmly. That's why understanding what's happening now matters so much. Not to panic, not to predict exact dates, but to recognize the phase we're in. Because financial crises don't begin with chaos. They begin with silence, and silence is exactly what we're seeing today. To really understand why this matters, we need to talk about where that $4 trillion actually went. It didn't disappear into thin air. It moved into places that signal caution, not confidence. Higher interest-bearing assets, tighter balance sheets, and defensive positioning. This kind of movement tells us that large players are no longer focused on growth. They're focused on survival and control. And when big money shifts from expansion to protection, it changes the entire behavior of the system. Banks, for example, don't announce when they start pulling back. They don't hold press conferences to say lending standards are tightening. They simply approve fewer loans, demand stronger collateral, and quietly reduce risk exposure. To the average person, nothing seems wrong. But to businesses that rely on credit, the pressure builds fast. Projects are delayed. Hiring slows. Cash flow becomes more important than growth. And that's how economic momentum quietly fades. At the same time, markets start sending mixed signals. Some assets remain strong, creating the illusion that everything is fine. Others begin to freeze. Trading volumes drop, and price discovery weakens. This confuses most people because it doesn't look like a classic crash. It looks uneven, unstable, and unpredictable. But that's exactly what early-stage stress looks like. It's not loud, it's fragmented. What makes this phase so dangerous is leverage. Modern financial systems are built on borrowed money. Governments borrow, corporations borrow, consumers borrow. Leverage works beautifully when liquidity is flowing. But when liquidity tightens, leverage turns into a trap. Refinancing becomes harder. Debt servicing becomes more expensive. Suddenly, past decisions made under easy money conditions start to look reckless. At macro signal, this is where we pay close attention to behavior rather than headlines. Are institutions extending risk or pulling it back? Are markets rewarding speculation or punishing it? Right now, the signals lean clearly toward caution. And when caution spreads quietly, it often accelerates suddenly later. Another key piece people overlook is confidence. Financial systems don't run purely on numbers. They run on trust. Trust that counterparties will pay. Trust that markets will remain liquid. Trust that support will arrive when needed. When liquidity leaves, trust slowly erodes, not all at once, but enough to change decisions, enough to make participants hesitate, and hesitation is deadly in highly leveraged systems. This is why calm markets can be misleading. Calm doesn't mean healthy. Sometimes it means suppressed stress. It means problems are being postponed rather than resolved. And postponed problems have a habit of returning with more force. History shows us that repeatedly. The longer stress is hidden, the sharper the adjustment when it finally appears. If you're still watching at this point, you're already ahead of most people. You're seeing the phase most skip over because it doesn't feel dramatic. But this is the phase where understanding matters more than prediction. We're not trying to call an exact crash date. We're trying to recognize conditions. And those conditions right now suggest that the system is becoming less forgiving, less flexible, and more fragile. The question isn't whether volatility returns, it's when and from where. The quieter things get now, the more likely the next move surprises people. Because systems under stress don't break where everyone is looking. They break where pressure has been building unnoticed. One of the biggest mistakes people make during periods like this is waiting for a headline to tell them something is wrong. But by the time a headline appears, the damage is already underway. Financial stress doesn't announce itself. It shows up first in small, almost invisible ways. A market that reacts slower than it used to. A funding window that quietly closes. It's a deal that doesn't get renewed with no clear explanation why. This is also where psychology takes over. When liquidity is abundant, confidence feels permanent. Risk feels manageable. Everyone believes they'll have time to react. But when liquidity starts leaving, reactions become delayed, then compressed. What once unfolded over months suddenly happens in days. And people who thought they were safe realize they were positioned for a world that no longer exists. We've seen this pattern before. In past cycles, stress didn't start with crashes. It started with with hesitation. Lenders paused. Investors demanded higher returns. Borrowers struggled to roll over debt. Each step seemed rational on its own, but together they created a feedback loop that tightened conditions faster than anyone expected. And once that loop forms, reversing it becomes extremely difficult. Another issue most don't consider is timing mismatch. Many assets are long-term, but funding is short-term. This works only when liquidity is stable. When it isn't, even healthy-looking balance sheets can fail. Assets can't be sold quickly without losses. Cash isn't available when it's needed. And suddenly, solvency questions emerge where none existed before. At Macro Signal, this is why we focus on flows, not opinions. Opinions change daily. Flows reveal intent. And right now, the intent we see suggests caution, preservation, and reduced exposure. That doesn't mean panic. It means preparation. And preparation often precedes instability, not after it. It's also important to understand that financial systems don't fail evenly. Some sectors feel pressure early. Others remain calm longer. This unevenness creates confusion. People point to areas that are still strong and assume the system is fine. But strength in one area doesn't cancel weakness elsewhere. It often masks it. This is where policymakers face their hardest decisions. Support too early and risk creating new imbalances. Support too late and the system seizes. And because no one wants to be blamed for acting too soon, action often comes only after stress becomes visible. That delay is critical. It allows pressure to build quietly beneath the surface. If you've stayed with this video so far, you're understanding why this moment matters, even though it doesn't feel urgent yet. This is the part of the cycle where attention is low, but consequences are being set. The choices made now or avoided now shape what comes next. And this is also where individual decisions matter. Not in reacting to fear, but in understanding risk and knowing where leverage exists, recognizing that calm markets don't guarantee safety, because when liquidity leaves quietly, it doesn't ask permission before returning loudly. As this pressure builds, something else quietly changes: behavior. Investors stop asking how much they can make and start asking how much they can lose. That shift doesn't happen overnight, but once it starts, it spreads fast. Risk appetite doesn't vanish all at once. It shrinks. Shrinking risk appetite is one of the clearest signs that liquidity stress is becoming systemic. You can see it in how markets respond to news. Good news doesn't push prices as high as it used to. Bad news, even small bad news, causes outsized reactions. That imbalance tells you the cushion is gone. Liquidity used to absorb shocks. Now, shocks pass straight through. When that happens repeatedly, confidence erodes further. This is also when narratives start to break. For a long time, people believe certain assets are safe, certain institutions are too big, and certain systems are backstopped. Those beliefs hold only as long as liquidity supports them. When liquidity tightens, guarantees start to look conditional, support starts to look political, and stability starts to look fragile. What makes this phase especially dangerous is that most people are still positioned for the old environment. Portfolios, business plans, and even government budgets are built on assumptions of easy funding and smooth rollovers. When those assumptions fail, adjustments aren't gentle, they're abrupt, and the longer adjustment is delayed, the more violent it becomes. At Macro Signal, we often say that financial crises don't begin with panic, begin with denial, with explanations for why this time is different, with arguments that stress is temporary, contained, or irrelevant. But denial only works until math intervenes. Cash flows don't care about narratives. Debt doesn't care about optimism, Markets don't care about comfort. Another overlooked factor is interconnection. Modern systems are tightly linked. A problem in one area doesn't stay isolated, It travels through funding markets, derivatives, and balance sheets. That's why liquidity matters more than headlines. Liquidity is the transmission mechanism. When it weakens, problems spread faster and farther. This is also the point where volatility feels random. Moves don't make sense. Correlations break. Okay? Assets that shouldn't move together suddenly do. That randomness isn't chaos, stress revealing itself. It's the system searching for stability and failing to find it easily. If you're watching this and thinking, but nothing has really broken yet, that's exactly the point. Systems rarely break when everyone expects them to. They break when attention is elsewhere. Okay? When confidence is just high enough to prevent preparation, but low enough to prevent resilience. And this is why understanding this moment matters more than reacting to the next headline. You don't prepare for financial stress when it's obvious. You prepare when it's subtle. When liquidity is leaving quietly. When behavior is shifting slowly. When risk is being repriced without warning labels. We're not saying collapse is guaranteed. We're saying conditions are changing. And when conditions change, outcomes change. Those who recognize that early have options. Those who ignore it are forced to react later, usually at the worst possible time. As we move closer to the end of this discussion, it's important to understand one thing clearly. Moments like this don't reward panic, and they don't reward ignorance either. They reward awareness. When liquidity leaves quietly, it creates a gap between perception and reality. Right? Most people operate on perception. Very few adjust to reality early enough. This is why history often feels unfair. By the time outcomes become obvious, the opportunity to prepare is gone. The people who moved early look lucky. The people who waited feel blindsided. But luck usually isn't the difference. Timing and understanding are. And timing always favors those who pay attention before pressure becomes visible. Right now, the system isn't screaming. It's whispering. It's telling us that flexibility is decreasing, that margins for error are shrinking, that leverage is becoming heavier. These aren't predictions. They're conditions. And conditions shape behavior long before they shape headlines. At Macro Signal, our goal isn't to scare you or tell you to run for the exits. It's to help you see the environment for what it is, not what it used to be. Because decisions made in the wrong environment, even good decisions, can have bad outcomes. Understanding context matters more than confidence. This is also why conversations like this matter. Not because everyone will agree, but because thinking critically is becoming rare. Too much content focuses on what people want to hear. Very little focuses on what they need to consider. When liquidity tightens, comfort becomes expensive. If you've watched this far, you're clearly thinking beyond surface-level narratives. And I'm genuinely curious what you think. Do you believe this quiet shift will reverse smoothly, or do you think pressure is building for something sharper? Just drop your thoughts in the comments. I read them, and they help shape what we cover next. And if this video helped you see the system a little more clearly, share it with someone who still thinks calm markets mean safety. These conversations matter more when they happen early, not after the fact. Financial cycles don't repeat exactly, but they rhyme closely enough to recognize the pattern. Liquidity expands. Risk builds. Liquidity tightens. Stress follows. The only real question is where you are in that sequence when awareness arrives. Thanks for spending this time with Macro Signal. Stay curious, stay aware, and stay ahead of the signal.